Rates have been at the epicenter, so I've been told, so everyone's been told about the market turmoil that we've been seeing. As we see these rate stories play out, is it fair to say that they will continue to be a driver of the volatility that we are seeing?
Without a doubt. I mean, how fast it unraveled was pretty impressive. I mean, last week, obviously, earlier in the month, good news, good data. It was kind of virtuous. It was good for the equity markets as well as for the bond market, rising yields for the right reasons. We had a big snap higher, and that really spooked the markets. I mean, that 325 level is proven to be a really critical level for markets to digest.
Now, Larry, as we talk about the movements in the markets, we have seen a massive sell-off and one that looks like it's going to continue today. Does it feel like to you that there is a bottom in sight, or is this the beginning of something much deeper?
Well, you have to remember the correlation between stocks and bonds has been negative for the last decade. And this year, on a monthly basis, we're positive. So what that means is this month, or the last 40 days, bonds have lost close to $2 trillion. So $2 trillion was lost in bonds before this stock pullback. Okay? So the last 10, 20, most of the last 25 years, bonds have been a cushion for stocks. Every time stocks have sold off in the last 20 years, just about 90% of the time, bonds have given a cushion. Now we're selling off in equities, but bonds had already lost $2 trillion globally. And so now stocks are catching up. So net, this move of passive asset management, $2 trillion has gone into passive. And for the first time, people are going to get their statements, and they're losing on their bonds. They're losing on their stocks. And that's going to force more selling. It's going to be probably double or triple as long as the sell-off was in February.
All right, so George, as we talk about that kind of environment, if he is right, and we do see a deeper pullback here, it stands to reason that safety assets like Treasury bonds and notes, like the Japanese yen, like Swiss francs, like gold, traditionally viewed safe havens, could catch a bid. Yet we are not seeing any kind of real safety move as of yet, certainly not to Treasury bonds and notes. Why is that?
Well, I mean, a combination, yes. I think the losses that we've already experienced are pretty big. And it's not as if there's a finite supply of treasuries. There's going to be a lot more treasuries coming down the pike. And I think markets are realizing that the supply deluge is the perfect storm. ECB pulling back, the Treasury pumping in all these treasuries. I mean, given where rates are in the very front end and where cash yields are altogether, cash has become an alternative asset class. So the flight to quality could just be cash. And then we've not had that for over a decade.
Are you saying from a rate strategist standpoint that bond yields at multi-year highs and savings rates, money market rates at multi-year highs as well, now provides an attractive alternative?
It's competition.
Yes, it is competition.
Without a doubt. Without a doubt. And that's why the curve is steepening in this sort of environment. I mean, the Fed has not done hiking yet, and the curve is steepening. That is usually counterintuitive where we are at the part of the cycle. We don't think the Fed's going to stop hiking, but this sort of kind of reflex in the back end of the curve is a reminder that yields were too low to begin with.
Now, George, Larry, Jim Cramer did sit down last night with Barry Sternlicht. He's the CEO of Starwood Capital. They were on Mad Money last night. Jim asked about the health of the U.S. economy. Sternlicht says costs in the real estate market are rising for materials and for labor, and we may not feel the full effect of those tariffs until next year.
I think the Fed is going to have to be careful. The economy is not quite as strong as the number indicated. And
okay, can I just say, I feel it's only you and me.
That's probably right.
But we're right.
Yeah.
All right, Larry. Barry Sternlicht says the economy is not as strong as the numbers would indicate. Do you agree? And if that is the case, what else can we expect to see in this market?
Well, remember, 2-3 years ago, when we had a cold winter in the first quarter of, say, 2014, brought us close to recession. So a 200 basis point increase in interest rates on the front end, so 2-year treasuries are close to 3%. As George is saying, yeah, it's a huge drag on the economy. Housing, as we pointed out last week on our Bear Traps blog, housing has been in a bear market for much of the last month, housing stocks, and the regional banks went into a correction maybe about 10 days ago. So you're definitely, hold on, this is the biggest point. Goldman Sachs, their regional lending platform called Marcus, this is something that happened this week. They lent $4 billion the last 2 years, $4 billion. They are scaling it back. So something's going on the consumer credit side because of this increase in rates, and Goldman smells it, and they're pulling back. So that tells me that near term the economy is not as strong as people think, because Goldman would be increasing their lending platform to consumers, not pulling it back.